We can argue about whether it's worth the price being paid, but let's talk about what that price is first. And that I'm talking about the price in reduced global trade. Can you quantify how bad is it?
Well, it's difficult to say. You've got the problem that the globe is growing more slowly, and you could say trade's down because growth is down. But I think there's a lot of reason to suspect that the growth is slower because we've got the South Korea example of a trade-reliant country seeing international trade drop off and it hurting things domestically as well. So I think this has been a real wake-up call for the global trading community about the importance of maintaining the traditional approach, multilateral, reducing barriers to trade as a way to raise growth around the world.
If the efforts by the president to redo trade terms with China and with others has been suppressing to some extent global growth and international trade, does that mean that if that is relieved, there's an upside here? For example, if we come out of the meetings today with at least the framework for an agreement on these 5 heads that we've reported about, a memorandum of understanding, is there some upside?
Well, I think everyone can agree that China was not living up to its international obligations. That was obvious. The president brought a new strategy to that, and it's had some fallout and some real costs. I think they're getting close to the finish line. The question is on what? It could be something as simple as reducing the bilateral deficit by having China buy more. That wouldn't deal with the structural issues. It might relieve markets who you take more tariffs off the table, but you wouldn't solve the long-run problem. Or they could be as successful as structural reforms on intellectual property, joint ventures, and the like, with verification down the road. That seems unlikely. That's a lot to get done in a short time. So they'll probably end up in the middle ground somewhere. Some pledge for structural reforms, but the need to meet again to deal with the verification and compliance with that agreement.
Doug, we're all focused on China right now. It's such a big country, such a big trading partner, and of course we're going to have the meeting today. But also there's a lot of issues with Europe, and particularly possible tariffs on auto imports that the president has talked about more than once. We got numbers out of Germany overnight that basically said in the fourth quarter there was 0 growth in the GDP, mainly because the inventories they were using, they were auto inventories they were basically selling off. The biggest growth by a long shot was actually government investment. What is the situation in Germany and Europe more broadly in the terms of their growth?
I think they're really struggling right now. I think many people had suspected you might see those numbers actually be negative. And so the public sector has held up the numbers anyway, but that's not Germany's preferred way to grow, that's for sure. And I think there's a lot of weakness across Europe. And that, I worry, will in fact empower the president to threaten the tariffs, knowing that they really don't want to deal with the trade war at this moment for purposes of bringing them to the table. But at the same time, he has shown a propensity for actually imposing tariffs to shake up the negotiations at the outset and then proceed. I think that'd be a misstep at the moment, and I hope we don't go down that road. Okay,
I want to turn to the Fed, the central bank right now, and what's going on there. As you know, the central bank had been indicated they were sort of really going to be in tightening mode, and they seem to have changed. Most people interpret that as almost a 180 of what they've done. We talked yesterday to Steve Moore. He's the president of Trump's 2016 campaign advisor, about what role the Fed has played in terms of the strength of the dollar, and here's what he had to say.
Let me be very clear about this. I think the Fed is way, way too tight right now. I think that we don't have enough dollar liquidity in the market. I mean, everyone agrees that the Fed made a catastrophically bad decision in December. Even the Fed admits that now, as you just reported.
So it's interesting, catastrophically bad decision. Certainly the markets reacted badly, and they turned around when they changed. But was it catastrophically bad for the economy?
I don't think so, and I worry that sometimes that the Fed pays too much attention to the market in the near term. But I think, number one, on the merits, the Fed is not too tight. For them to have essentially a 1% real interest rate is not something that's dramatically too tight, given the strength in the economy that remains despite the headline noise. We still have a household sector that is 70% of the economy and has grown rock solid between 2.4 and 2.9% for years now. So going into 2019, there's a lot of momentum, and there's no reason for the Fed to be looser than this. They do have a problem, though, because either they have convinced markets that they're not going to move again and they need to, or they've decided that they don't need to move again, and I think they're probably wrong. But either way, they need to work on their communication strategy.
Well, that's the question. We had the Fed minutes out this week, and it basically all had to do with inflation. And what are they going to see with inflation? Is it going to be above the 2%? Is it going to be at the 2%? At this point, why do they need to raise? Because inflation is not zooming, it wouldn't feel like.
I think they correctly said we don't need to raise right now, but they shouldn't take raising off the table. I mean, certainly you have to move preemptively if you're a monetary authority. Inflation always comes later in the game than you expect, and this is an economy that is well below normal measures of full employment. It's an economy that is growing more rapidly than most people estimate the trend. Those have historically been the elements that give you higher inflation. And, you know, the Fed's undershot, but it hasn't undershot dramatically, and that could reverse actually relatively quickly.